I really want you open to this. You got to be sold on this emotionally. We can know up here that it makes sense, but if we don't feel it, we ain't doing it. And so I want you to feel the power of the IRA and 401k.
401ks in any employer-based plan, the OJ pension, the 401k from a company you own or, a day job. You got the Dunder Mifflin 401k, your Jim Halpert Big Tuna, you got your 401k account there. All right, so when you get sued, unlimited creditor protection. This is under ERISA, the federal government law. So no matter what state you live in, you get unlimited creditor protection.
Welcome everybody to another episode of the Directed IRA podcast, the sister podcast to the Main Street Business podcast. I'm here with the GOAT of all time on self-directed strategies, the author of the Self-Directed IRA Handbook, Matt Sorensen himself.
Wow. Well, thank you. I appreciate that. Well, I'm here with the legend who told me what a self-directed IRA was in the the place. So, guys, you're in good hands today.
Yeah,
apparently,
thank
you're,
you. And I have
great.
Well, thank you. Enough backslapping here, but I have written a book on asset protection. Talked about it a lot. Several sections of books on it, and that's the topic today. This IRA 401k asset protection conversation. A lot of people don't talk about this.
Yeah.
And so today is. You got to know a secret here that is really amazing.
Yeah, I mean, a lot of people think of IRAs and 401ks and it's building for retirement. I got all these great tax benefits, tax deductions when it comes in on traditional accounts, tax-free on Roth on the way out. I'm building the account. I'm not paying taxes. I'm making money. But also, your IRA and 401k have amazing asset protection because you can get sued, you can file bankruptcy, and you get to keep your IRA or 401k.
Yeah, let me give you an example. Do you remember the guy called OJ Simpson?
The Juice.
The Juice. I mean, when I grew up, he was, leaping over, suitcases at the airport on his way to Hertz. But those were the good old days in the 80s. But the Juice, OJ Simpson, still to this day has his 401k. After all the lawsuits, after all the craziness, he still takes, I don't know if he does it monthly or quarterly or annually, but he takes distributions out of his 401k that he earned at the NFL, and no one can touch it. Not the feds, not the IRS. Well, I should say
the IRS could.
The IRS could if he doesn't pay his taxes.
Yeah.
And if he was getting divorced, he would have to split it up with his spouse. But that's it.
But the judgment he got against him, I remember OJ Simpson, his cases, right? There's movies about this stuff, right? Not guilty criminally, but he lost the civil case.
Okay? $32 million case.
Yeah, the family, Nicole Brown Simpson family, sued him and won civilly, and he has this massive $30 million plus judgment they cannot collect on. Yet he gets his NFL pension, employer, kind of ERISA protected plan, and he can file bankruptcy. He gets to keep the whole damn thing.
And we have some clients that are like, hey, I get it. I'm putting money into my IRA every month or my 401k to get a tax benefit. It's going to grow tax-free, yada, yada. But they're like, I'm putting it there because if I'm texting and driving tomorrow and getting a lawsuit, they can't touch it. Mm-hmm. It is literally protected. And so clients see it as a safe deposit box that is really, really locked down from any possible creditor.
Yeah.
And then they're investing in it. And then they're growing it.
Yeah. And it's funny that example you gave, because I've talked to clients over the years who value the asset protection more than the tax benefits of this. Like physicians and doctors. I remember I talked to an anesthesiologist and he's like, man, you just get sued all the time in my business. And I'm just worried about some malpractice case and a problem happening. And all these things I've worked for, all this wealth building, one thing goes wrong, one patient, and I could lose it all. And he's terrified about it. But he's like, but I know they can't get my IRA or 401k.
Yeah. Now, let me give another example of where we miss this. And I'll take a little personal accountability for good and bad I've done in my life in this area. But I have a client that's a farmer, and farmers tend to value the land more than cash assets or investments in Wall Street. Farmers are a little more like, hey, I know my land. I know land's never going to go anywhere, la, 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 la. But there's a point. And I grew up on a farm. I own a little ranch I'm trying to build out and get cows dialed in. I just bought How to Raise Cows for Dummies.
Okay.
It's exciting.
Okay.
How to raise cattle.
All right.
I'm learning. But anyway, what farmers come to a point where all of a sudden they realize this eternal truth that many of you have heard. Land rich, cash poor. And a lawsuit happens, they can go after the land. And I've had so many farmers say, oh my gosh, if I would have just taken 10% of my profit, 5% of my profit from my potatoes or my corn or my soybeans or my wheat, whatever it was, if I could have just taken 5 or 10% of that and peeled it off and put it in this Roth 401k or Roth IRA, I would have it protected and I'd have it diversified from my main core asset. And this is where I got to compliment my partner, Matt Sorensen, over the years. He's been religious. He's been doing his little 6K, 5K, 7K every year in the IRA. Oh, you can do a little bit in the company 401k because we have restrictions. We have a group 401k. We can't stock away too much like a solo 401k. Some of you might want to do. We have a special coming up, by the way, in a few weeks we'll talk about. But Matt, you were religious. You just did that a little bit every year. Me, I drove a lot of my profit back into the business. I'm like, I'm going to expand here. I'm going to expand here. Now I'm business rich, but IRA poor, if you could say it that way. I mean, I've still got an okay IRA or 401k, but Matt's is much bigger than mine, and I'm jealous of that. That's protected.
Apparently, I appreciate it.
I tell you, I'm a little envious.
Yeah. Well, and I think there's obviously the tax benefits, the asset protection benefits of it, and let's break it down between 401k and IRA because it's a little different. In the 401k
I thought you were going to say, damn straight, business owners, diversified. Stay committed to that. Did you not like my point?
That was a good point. Well, let me just say this. I mean, let's just like peel back that comment here for a second. Is you're building wealth in general, and a lot of business owners get suckered into what Mark was saying about plowing everything back into the business. They're not pulling it out. They're not setting it aside in another account to go save and invest. And I can see there's competing priorities there for sure. But I'm just saying, add the asset protection benefit on this other side here, the diversification of it, that it's not all, your eggs aren't all in one basket in the businesses. And I think that leads people more to, even if I could get more return out of my money by putting it back in my business than I could over here in an IRA or 401k, even when I'm self-directing, there's still a lot of good reason to put it over here. Asset protection, diversification from my main business. I think there's some cool little benefits to it. So,
yeah, that's what I wanted to emphasize right here, because if you're not sold on the why and the feeling of security and protection, you're not going to do this. You're not going to care about the technical points we're going to make here in a moment because you want to know them and the procedure and some of the more finer points, which are really fascinating. We're excited to talk about it. But I just want you, if you're listening right now, I really want you open to this. You got to be sold on this emotionally, because emotions is what drives us to do things. We can know up here that it makes sense, but if we don't feel it, we ain't doing it. And so I want you to feel the power of the IRA and 401k and that security it can give you later on in life when you got teenage drivers, or maybe you shouldn't be driving.
Yeah, and I think, the more like wealth you accumulate, the more you're in business, the more rental real estate you have, the more risk for lawsuits that you accumulate. It's just the nature of the business, and you're going to get sued one day if you have any business or investments of substance. You're going to get sued. You are. So how are you protected? Where are your assets? Obviously, you want to be doing all the other asset protection things, but your retirement account is one of these easiest ones to just have locked down. So let's get some money set aside there. This is like a fortress of solitude. Like no one's getting into this thing. Okay, you can file bankruptcy and keep your retirement account. All right. So let's talk about the plans. We'll hit the finer points now.
Okay.
401ks in any employer-based plan, the OJ pension, the 401k from a company you own, or, a day job. You got the Dunder Mifflin 401k, your Jim Halpert Big Tuna. You got your 401k account there.
Yep.
All right. So when you get sued, unlimited creditor protection. This is under ERISA, the federal government law. So no matter what state you live in, you get unlimited creditor protection. Yeah. The $30 million, judgment, not going anywhere.
That's the creme de la creme. So let's repeat that. I'll set the stage here. Not all retirement accounts are created equal in the asset protection you get. So now they're all pretty freaking awesome. Yeah. But we do want to let you know that some get like carte blanche, creme de la creme, Cadillac, whatever, top of the line protection. And the first one that Matt just said was that employer-based plan, where it's not a solo 401k, you're contributing, they're matching, blah, blah, blah. Those, again, back to our point, the IRS and your ex-husband or ex-wife, they're the only ones that are going to get a piece of that. They're protected.
Child support could be too. Like a child support order could possibly get through that. Like if you're failing to pay that.
Okay.
But don't be that person.
Well, no, what's
I don't want you getting protected
I don't want
if you're not doing that. Anyway,
we're not going to help you through that. Okay, so next tier down.
Okay, next tier down is going to be
the solo.
Well, let me say solos. Solo Ks are a little tricky. A lot of people think, well, it's a 401k, Matt, it gets ERISA protection. And the law actually says single employee solo 401ks, individual Ks, do not get ERISA protection because ERISA is meant for the employer-employee relationship. And in a solo K, you are employer and employee. So technically a solo K is going to fall under IRA rules.
What happens if you're employing your spouse or children?
It's still
going to be a gray area.
They're deemed owners or family. And so solo Ks just think you're an IRA. And a lot of people oversell the solo K and be like, you get ERISA protection. No. I've written articles on this, okay, about the creditor protection. You don't get it. The ERISA is very clear, actually, on that. There's some guidance on it.
So does this mean there's really 2 tiers?
There's really 2 tiers.
It's just
Well,
employer plan and then everything else.
Yeah, but the IRAs, then we go to the IRAs, then we got 50 different outcomes. But there's some common themes.
Same with the solo K. The solo K falls into that 50 different outcomes.
Exactly.
So tier 2 is 50 scenarios.
Yes, of IRAs. So let's just talk about those. So there's kind of a few different categories of where you might get treated. I would say 40 to 45 states say your IRA is protected, period. No cap, no limit. They're like, you're protected. Now, some of them will say if you contributed in the last 6 months or the last year, like your last contribution might not be.
Yeah, or if you got in a car accident and the next day you put in a big deposit.
Exactly.
That kind of stuff.
Like they're going to be like, that's not protected. Yeah. Then you got another little group of states that might say it's capped at $1 million. And there's not caps really below that. They're kind of like it's at $1 million or $1.5 million. Okay. Then you have a very few states, California being the biggest. Of course, there's always the California caveat that say, we protect your IRA up until the amount that it is determined you need it. Okay. So,
in their minds.
In the government's mind. You have to argue that to a judge, of course, in California and say, well, and here's what you would say. And it says that you and your dependents need it and rely on it. So if you really are broke, and let's assume you had a lawsuit against you and they went after every other asset they could get. And the last thing you got your IRA with $1 million in it, I think you could actually be able to keep it because you're going to be able to say, hey, I got a spouse, I got kids, or, maybe I care for an older parent or something. Like, you're going to have some need that you're going to be able to show to keep it. And also in California, what they say is, and I got an article on this too, is if you roll over a ERISA plan to an IRA, you actually get ERISA protection.
Oh, there's the tail.
So if it's a rollover from a 401k into an IRA, then you actually get ERISA protection. You're not just under the IRA.
So it's colored or tainted or traced back.
They call it. It's not. I think it is. Tracing might be the word. They do. They have a word for that.
Oh, that's cool.
It's. It might be tracing. I don't know. It's not tainted. That's
no. That's
that's bad.
It's blessed. It's blessed.
Yes, it's blessed. There's one big thing left, though.
Okay.
There's one big thing left, and I want to make sure everybody understands the distinction is. When we're talking about this asset protection for your IRA or 401k, I'm talking about you getting sued. I'm talking about a lawsuit against Matt Sorensen, and they're trying to collect against the assets that Matt Sorensen owns. And they're going to say, Matt Sorensen's got an IRA. Matt Sorensen's got a 401k. I want to collect on him. I'm going to be like, tough luck. You're not going to get it. Okay? That is the asset protection for IRA. On the other hand, let's say you have a self-directed IRA. You bought a rental property in the IRA. Tenant slips and falls. Now this is the tenant suing the IRA for what the IRA did and what the IRA owns, not them suing you trying to get into the IRA.
Yes.
It's different.
Yeah, and what's interesting on this point is people think, oh, well, my IRA is 401k is protected, meaning it can go out and just be a crappy landlord, or it can go do business and it's protected. No. Let's say it another way. When your IRA or 401k goes out and does business, it's liable for its own actions. That's very different than topic number 1, where you're out there getting suited individually and your 401k is on an island. We're going to protect that. But once your island starts to do business, and there's typical good island shows right now, where young people get together and
are you into those?
But, the kids are trying to get us to watch in. Root for certain couples. Yeah. But anyway, if that island starts to do business, then it's liable for whatever happens on that island. I'll tell you, a lot of things happen on those islands.
I don't want to know. I don't want to know.
But so don't think your IRA or 401k has carte blanche to just go out and be dumb. So that's why the LLC is very, very important.
Yeah, that just goes back to that, and I think a lot of people are like, do I need an LLC? It's like, well, what are the benefits of it? Checkbook control and asset protection. So if you do have the rental property, you're flipping a property, I love the LLC. Great, I get checkbook control for the IRA LLC, but I also get the asset protection. So if something happens on the property, they can just sue the LLC. On the other hand, if you're like, well, Matt, my self-directed IRAs invest into XYZ private fund LLC. Do I need an LLC? No. You don't need checkbook control, and you don't need asset protection. There's already an LLC up there that you're invested into. And so the asset protection is helpful to you if you're making those direct investments where you've got tenants or you're dealing with contractors. Think of it, is there risk in my investing that I'm doing? If there is, look at using the IRA LLC just for the asset protection.
Yeah, and now for some of you that are maybe new to the show, and I want to just make one quick statement here for some that might have been confused about what we just talked about. When you take your IRA or 401k and start investing it into small business, active projects, real estate, you are now doing what's called self-directing. And you are directing your retirement account to do something. You're self-directing their account to go do something. Now, that account is now liable for its own actions, but you want to control it. You want to make it simple. You want to make it easy. You want to get a greater rate of return. So that process is oftentimes simplified with this LLC. So your IRA or 401k sets up an LLC. Not you. It's not your LLC. You could be the manager of this LLC, but your IRA or 401k is going to be the owner of that LLC to protect itself from what it's doing. That's this whole other angle we're looking at here. So that a creditor's not coming after you in this situation, it's coming after the LLC owned by your IRA or 401k. Now, so for some of you that maybe that seemed a little gray or hazy, I wanted to break it down into a few pieces and parts there. But you would meet with one of our lawyers at KKOS Lawyers and say, hey, I want to self-direct. I want to go buy some real estate directly. I want to go do a small business or invest in my brother's restaurant or landscaping business or my sister's cupcake store or whatever. Then you're going to want that LLC protection to really protect your IRA or 401k that could from something going wrong. Now, if you're just going to buy stock or syndication or do venture capital or whatever, who cares? But those smaller businesses, you need that extra layer.
Yeah, extra layer. I like that. All right. Well, hopefully that helps you understand how your IRA or 401k is protected in the event of a lawsuit, whether it's you getting sued or your self-directed IRA getting sued. The nice thing, again, about this is it's an excellent place to build and grow wealth. There's all the tax benefits of it. We talked about it. Everybody knows that. But I like thinking of it as this safe place where you know if shiz literally hits the fan, you have that lawsuit that could be devastating to your business or your other investments, you know you're at least going to keep your IRA or 401k.
Love it. So, well, thank you, everybody, for taking your valuable time to participate in another podcast about building wealth, protecting your assets, using your retirement account effectively. We are here for you. Please look at the links down below to Directed IRA or even the law firm, Main Street Business Services. We have a family of companies that are going to help you reach your dreams of building wealth. We're not going anywhere, and we'll see you next week for another episode.
See you then.